Right, this is the third webinar of my series, Tips to Save You Pips, and it's on the perils of overtrading and overleverage. And it's a couple of topics I actually think you should be very aware of because it's can have a very negative impact on your trading. And you need to be aware that overtrading and overleverage are two significant problems that a lot of retail traders can face, and they can fall into the trap of doing both aspects into their trading. And it is a very important issue that can have a big detriment to your account. I will very quickly show you my disclaimer. The disclaimer being, because we're going to talk about live market information later, I'm going to talk a little bit first of all about overtrading and overleverage, and then move on to live market information and looking at a lot of volatility in the markets at the moment. So read and understand the disclaimer, and I'm going to put it up back at the end as well, just in case you've missed it. Right. Biography, very quickly. Been in the markets for 14 years looking at FX and equities. So within that, I've got my STA diploma, which is Society of Technical Analysts diploma, and also MSCI as well, which is an investment management diploma as well. So pretty well qualified to speak today, I hope. Anyway, right, what I will do is just quickly run through the agenda. Basically, just looking first of all at overtrading, what the signs that you could be overtrading, and also tying it into emotion trading, because that's, again, emotion trading has a big impact across a lot of these topics that I talk about, but again ties into overtrading. Again, then overleverage, what is it, and the key signs to look out for, and how you can fall into the trap of being overleveraged. And then I'm going to look at what these two aspects of trading can do to your account, and also what you can do to prevent them from having an impact across your account as well. Then looking at live market information, and as ever across all of this, if you've got any questions or anything you want to talk to me about or ask me, then please feel free to just type in the chat box. Absolutely. All easy, and it'd be good to get some feedback off you anyway. So yeah, just in the chat box is absolutely fine. Right. Oh Christ. Here we go. This bloody system, eh? 1, 2, 3, 4, 5. Try that. Okay. First of all, what is overtrading? Now there are several aspects to overtrading. Now, if you're trading on ideas, for example, that don't conform to your predefined strategy, then I would say that it can be a big sign that you're overtrading. For example, forgetting about you're actually putting on, certainly you are becoming detached from your trading strategy, having too many trades open at once, or putting trades on without putting the required thought. But what I'm going to do is talk you through each set in. What I want to be doing is looking out for signs that this is what you're doing in your trading, and therefore trying to sort of prevent it from happening. Okay, the traits to be aware of. First of all, having too many trades open, having a lot of trades is not necessarily a thing. I suppose it just depends on whether your risk per trade is actually adjusted accordingly, and your strategy can have 20 or 30 trades per day. Maybe your risk per trade would be, say, a tenth of the amount of a trader who's trading maybe twice or 3 times a day. And if that is the case, then you are going to be okay doing it that way. However, as I stressed, you need to make sure that your risk per trade is adjusted accordingly. So if you're trading, say, 4, 5 or maybe 6 times a day, and you have the same risk per trade as someone who's trading maybe once or twice a day, then I would say that you're taking on a much greater risk, and potentially you could be over trading. So basically it comes down to, I suppose, how much you've got on your account, and the amount that you're risking in the market across the course of one day. And I've said previously that in another webinar that I've done that risk per trade into double figures is looking excessive, and you can actually do the same thing if you do if you're sort of running across a course of or a number of trades. And you may not have an enormous risk appetite, and you may have a low risk per trade on every trade. However, if you do lots of trades within that, then through the accumulation of the risk in that, then you might be trading far too much on the riskier side of the scale on the course of one day. So I suppose you could argue it's at that stage at which you may be overtrading and overleverage can come a little bit hazy, but still, certainly, I think having too many open trades at once is certainly running the risk of overtrading. Okay, number two, putting the trading before you actually put the required analysis in. Effectively, I suppose it's trading before you get the confirmation of your setups, really, or jumping in too soon. I have my trading mantra is the law of using the law of multiple confirmation, and that in that I would be using different trading signals and different setups that I want to have confirmation of before I'm looking to move on a trade. Now, in technical analysis, for example, which is what I use to do my my trading, is that false signals happen a lot. So you need to be sort of looking out for confirmation signals across your trading. I wouldn't be jumping in on just one signal, say, for example, Bollinger Bands or something like that, where you see a bit of a reversal. I wouldn't be jumping in on that necessarily. I'd be looking out for other signals to suggest to me that there is a reversal going on, and maybe you can trade with it. So you need to be looking out for multiple confirmation, in my view. So, I mean, basically, I suppose it's sort of when you use technical analysis, for example, you basically need to understand that you're not ever really going to get in at the bottom on a long trade, or you're never going to be shorting or selling at the top, because when you use technical analysis, it's all about sort of waiting for confirmation of indicators, really, and a lot of the time that will mean that the move has started before you can actually get the confirmation that yes, that is the move that's happening, and then you can make your decisions accordingly. So I would be far more confident and far more trading with higher conviction if I'm waiting for multiple confirmation. Trading the same setup more than once. Now, this is interesting because basically, say for example, you've taken on a trade and you've got a profit out of a trade. You've taken that position off the table, but then you start to look at it again and you think, well, should I have taken it off? And then you think, well, if I just put it straight back on again, that's fine. It's just effectively the same trade. It is not the same trade. You're effectively sort of using emotion trading again, which we talked about last time. You're trading on greed, and I think that is effectively another form of over trading. It's basically, although you're looking to run the winners, and say, for example, you've taken off and you think, oh, okay, well, that's a winning trade and it continues to go, and maybe I should put it back on again. Unless you've done all the required analysis again, because it's a brand new trade with a brand new stop loss and risk per trade and all that is going to have an impact. You need to make sure that you're trading that in isolation. It's not a continuation of the same trade. It's not the same mindset. You need to be having there's different parameters on this new trade, and this trade in the new setup may not necessarily be as strong as the old setup. So just keep that in mind, that just trading the same setup more than once can be a prime instance of over trading again, and is again emotion trading. Leaving your trades running over for well over their time horizon. Now, I suppose, I mean, say for example, if you're a day trader or an intraday trader, you've left positions open for a number of days. I suppose there's two different aspects or two different ways of looking at this, pros and cons to it, and it entirely depends on what's happening in the market. I suppose if the market is trending, you're looking and you're on the right side of that trend and you're running the trade, happy days, go with it. If the market is moving and I stress that because you're looking to run the winners, and if the market is moving in your direction and continues to go trend, why should you stop it? Just make sure you've got active trade management in it when you're sort of making sure you're nice and tight on your profit trigger in case the market starts to correct again. However, if the market is moved, it basically gone sideways, gone nowhere, and you're still running that trade, I'd say that is again an instance of overtrading, because basically you've made a decision and the market's gone nowhere. I would say that you need to just take a view that, okay, that trade has not worked out for one reason or another. It's not worked out. So don't leave it on, because you then become at risk of being sort of overexposed to market conditions, because and maybe you can't then put on another trade because you're tying up margin in that trade that you're just leaving on. And it becomes almost a 50-50 bet, really, because the market's gone nowhere. The signals that you thought you had before have not really worked out. And if you run it is effectively a 50-50 bet, in my opinion. So I'd rather take that position off and just look at something else and look for another signal that is a proper setup signal that actually you can trade with conviction again, because I think that's what you need to be doing, which is trading with conviction. An instance of where you've always got a position open. This is similar to leaving your trade open too long, I suppose. And if you're always in the market, the chances are that your strategy needs to be redefined, in my view. There are often times when it's best not to be in the market at all. And I suppose if you've got a feeling of if you desperately want, or even more dangerously need to be in the market, then it's probably a sign that you shouldn't be. If your strategy doesn't necessarily throw up any trading ideas, don't try and force it. Don't look for ideas that are not there, because you're going to be putting on trades for all the wrong reasons. And I would actually say that being out of the market or market neutral can be a form of trading, because just the market conditions are not necessarily favourable for that. Number 6, trading simply because you've just got the margin availability. Again, I mean, it's just all plays into this part of not thinking out your process, really, and your strategy. I'd say it's quite a lazy way of trading, and you're not actually looking at the bigger picture. First of all, it can leave you very overexposed to market volatility, and I'd say that it's the sort of thing, maybe this is a bit of a controversial one to say, but it's the sort of thing that you'd expect from an unscrupulous advisory broker to sort of be putting you into trades that you shouldn't really be in, and just to try and get you to trade. Don't trade just for the sake of trading, because the chances are it'll be the wrong decision. You need to, as I say at the bottom here, get out of the mindset of that you need to be in the market. Links for the motion trading, very quickly, just run through this because we went through this last time. I mean, anger, revenge can lead to trading in a rash manner. That can lead to you to putting trades on when you haven't put the required thought through. Being resentful, again, is another emotion. Being resentful of a trade that's gone wrong. Don't try and get even with the market. I mean, these are all sort of emotions that can drive over trading. And little box at the bottom here. Remember, a hot-headed trader will rarely make the right decision, and that is true. Because basically, overtrading is basically where you trade in a manner that becomes detached from your trading strategy. So a hot-headed trader will be doing that. Right, overleverage. Now, overleverage, I would class overleverage as trading in a manner that engages with too much risk for your acknowledged tolerance for risk. And I would say that trading doesn't actually, or shouldn't be, something that sends the pulse racing or pulse surging. I mean, if it's a case of you sort of having your heart pumping every time you're trading, you're probably over leveraged in your positions, because if your account is flying all over the place just on one trade, I mean, either and that is sort of concerning you, then that is certainly where you're taking on too much leverage. Maybe you're a bit of a gambler at heart and you want to be doing that. That's fine. That's up to you. That's not the way I trade. That is certainly not the way that I would do it. I would be taking on far more of a risk-averse way of doing it and making sure I put a lot of thought into my trading to try and actually win across a long space of time. I mean, there are traders out there that just fly in and out of trades all the time. Chances are you'll get blown up if you're doing that, because it's not a very sustainable way of trading. So if that is the case and you're trading and your heart's pumping and your sort of pulse is surging, I would say have a rethink of your strategy. Perhaps start off with a very low risk per trade and then build up slowly your risk per trade until it's at a level at which you're comfortable with trading. Ultimately, you shouldn't be running a risk per trade that means you're going to be sort of ruining your trading account in just one position if it goes wrong. Sort of all-in trading, effectively sort of putting all your chips on the table at once. I mean, that's just not really a sustainable way of actually winning at trading. Slow and steady wins the race. I mean, I've said that before, and I think that is the case that you need to be just looking out for, really. Now, I would say that a key signal to whether you're overtrading is your attitude to losses. I mean, if you're for example, we all make mistakes when you're trading. So the trouble with making mistakes when you're over-leveraged is that the mistakes that you make completely screw your mind. You have a completely different mindset as to how you're going to deal with those mistakes if you're over-leveraged, because, as I said before, the heart's racing and you make a mistake and it has a significant dent on your account, and you then start to get really you would then start to sort of get quite emotional about it. Again, emotion trading coming into it. Instead of using your mistakes to learn from them, you start to sort of start the blame game. You're blaming yourself, the market, whoever gave you the idea, whatever. But it gets into a situation in which it's not a positive reaction. You don't react positively. I mean, no one likes losing trades, but you need to understand that you're going to lose trades when you're trading. But the key point to make is that you need to learn from your trades, and that is what you struggle with when you're trading with an over leveraged position. Right, the trap of over leverage. Now, a couple of instances I've got here of where you can find yourself over leveraged without knowing. Now, I mean, there are different ways of being over leveraged. I mean, for example, the classic one would be not understanding the platform and accidentally putting in a lot size too big for you and whatever, this, that, and the other. That I'm going to presume for this process of this conversation that you are understanding how to use the platform, and you know what happens when you increase your lot size, is you take on a lot more risk. However, you can still be over leveraged and not just through your trading generally, but not really realize it. Now, I would say that my last webinar, I took you through how the calculation of your trade size and using risk per trade to do that. And it's a specific process which sort of stems from the amount you've got on your account and the amount you're looking to risk. Say, for example, on a 10 grand account, you're looking to risk, say, 1% of that, which would be $100. The way you then work out your trade size is to be done through the calculation of a stop loss. So if you've got a stop loss of, say, 50 pips, it's sort of worked out by dividing $100 by 50 pips. So subsequently, you're looking at a $2 per pip position, which is, if you know your platform and how to use it, it's 2 mini lots, which is 0.2 trading lot size. Now, if your stop loss is triggered on that position, you would lose $100. Now, within your trading strategy, that's an acceptable loss, because you've put a lot of thought into it and you think, I can handle $100 of loss in my trading strategy. However, say for example, you thought it was you liked the trade, and you thought it was a good idea to increase the trade size, the position size to one lot, which is $10 per pip. Now, you've got two options as to how to play this. First of all, if you want to keep the risk per trade of 1% on a $10 account, that means you still are risking $100. So that means 100 divided by 10, you can only allow yourself 10 pips of a stop loss. And I would say that that has to be an incredibly high conviction trade if you're going to be running at a 10 pip stop loss. You wouldn't be overtrading, because what you've done is you've increased the lot size, but you've reduced the number of stops, the number of pips in your stop loss. So you've got a position, you're running a position that you'd need to have a very high conviction trade in, but still you're not overtrading. But if you keep that original 50 pip stop loss and you trade in one lot size, then you effectively are risking $500 on that trade, which is 5% of your account, and it's a much higher risk per trade than you, well, according to your strategy that you're comfortable with, are there leveraged. So effectively, your trade size becomes too big to cope with the size of the stop loss being that wide. So if you are increasing your stop loss and you want to put on more, a bigger trade size, you need to proportionally reduce the size of your lot size. Sorry, if you're going to increase your lot size, you need to proportionally reduce the size of your stop loss. That is incredibly important to factor to get your head around. Right. Over leverage through overexposure. Now, this is basically where you're, say for example, you've taken a view and you've got a couple, your trading strategy or your signals have thrown up a couple of trades. Say, like, for example, you've got a short euro-dollar trade and a short cable trade. And you've got, so effectively, you've got two trading setups on multiple instruments. What do? Well, basically, both positions are running let me just think. Both positions are running a long dollar position, a long US dollar position. So if you traded both of those positions, you are effectively trading on a double long dollar position. If you're going short euro dollar, short cable, you're basically going double long on the US dollar. So anything that comes out, any bit of announcements that impacts on the dollar, that would have a double impact on your two positions. Or that would have a double impact on your positions. So basically, there are two ways of playing this. You can either, first of all, trade both, but reduce the risk per trade proportionally. So, for example, before we were trading 1% risk per trade. You want to trade two positions, long, short euro dollar, short cable. You would then reduce the risk per trade on those two positions to 0.5% risk per trade. So accumulatively, you're only doing a 1% risk per trade with both trading with across both positions. That's okay. But if you keep that risk per trade at 1%, you're effectively trading 2% risk per trade across both positions. So effectively, then you're becoming overexposed, over leveraged, and it is a bit of a problem potentially. Now, what experienced traders would do in that position is they would look for the best trade of the two and just trade that on its own. So you'd look for the best shorting setup on Eurodollar or the best and cable, and just trade that one. You would then just trade, say for example, cable had a brilliant selling technical sell signal. You trade that cable short, and you wouldn't trade Eurodollar, but you would trade that cable short on a 1% risk per trade. So effectively, because you're looking for to trade the high conviction ideas, that is the best way of doing it. Because you're getting a sell signal on both Eurodollar and cable, which would suggest to you that it's a high conviction idea that going long the dollar, because both trading setups have happened. But then you pick the best one out of those two ideas and trade that one. And that is how I would be doing it. Because otherwise you sort of run the risk of being overexposed and over leveraged. Right, okay, very quickly. The impact of overtrading basically just makes you feel very exposed, I would say, sort of juggling too many balls in the air. It can leave you feeling a bit confused, exposed to market volatility, and also overwhelmed by the whole situation. Outside your comfort zone is basically how you can feel. Now, the key point box here I've got is if your trading strategy is thought out properly and your preparation is done, you should not find yourself overtrading or overleveraged. Right, finally, the aspects of how to prevent them happening. First of all, understand the key signs that you're looking for in your trading. I mean, I've been through them before, so sort of things like too many open positions, running over your time horizons, not understanding the need to adjust your stop losses when you increase the trade size. That is your key one from overleverage. Number two, planning everything. Now, I would say that this is a big aspect of your trading anyway, but if you plan and organize your day, you're looking for, say, for example, the timing of key economic announcements and key different factors to look out for during the day. Plan your trading by looking at what actually might impact it through the day. So what is actually going to affect the timing of your positions? So if you introduce these sort of small aspects of timing into your trades by looking at calendars, looking at what's going to happen during the day, then that can also help to prevent the temptation to fly into trades, I think. So planning your trades and make sure they conform to your strategy. Keep a record of all your trades, sort of look at the times that you entered the trades, what was going on in the market at the time, look at the time that you exited your trades and what was happening in the market, what were the market conditions throughout the trade that you had on. Look for patterns in your trading style and actually find what works for you, because some people find that they trade much better in the afternoon, some people find they trade much better in the morning. If you find that there's a trend in how your trading is performing, how you're most successful, stick to that. Don't sort of play around with your afternoon. Say, for example, you find yourself trading very good in the European morning, and then into the afternoon, the US session comes in sort of 12:30, 1 o'clock, and you start seeing that every time that happens, you lose your trades, you lose your positions. If that's the case, then trade through the morning, and then maybe use the afternoon just to give you a bit of research time or something. Just be aware that there are different times of day, and also during the week as well. Different days of the week, often traders will find that they're better at. Learn trading discipline. So you're basically looking to be consistent in your trading. An inconsistent trader is not generally going to be a good trader. You're looking for self-control, not shooting from the hip, i.e. emotion trading, things like that. Trading with your mind and not your heart. Getting a handle on any sort of emotions that can impact on your trading. And above all, I would say stick to your trading strategy, because a well thought out strategy will mean that you'll be able to control the emotions that drive over trading. It will mean that you won't necessarily find yourself engaging in the same trade across different instruments and unwittingly becoming over leveraged. And you've got your key tip box at the bottom here, which is ask yourself one question: why am I opening this trade? If you can answer that question and it sort of falls within your trading strategy, then I would say that is a good time to be trading. If it doesn't conform to your strategy and you can't answer that question, why am I opening this trade, then it probably should be a sign that you shouldn't be necessarily trading at that stage. So that is pretty much it on the theory front. Now let's look at some markets. As I said before, anyone who's got any questions or anything, please put them in the chat box. Otherwise, I'm going to just run through the forex majors and see how far I can get in this. But should be some time for some questions if you care to ask them. Right, euro dollar. Now, obviously, we've had today just a significant amount of volatility on euro dollar. Big breakdown earlier on. Massive open to the downside, and we have rallied back quite strongly on euro dollar. Let me just see how far. We're only 18 ticks down on the day. Wow, on euro dollar. That was over 200 ticks at the earlier in the Asian trading session. Massive rebound. There's not a great deal that's happened that would be driving that rebound, but still, euro has unwound. Now, this is euro on an hourly chart basis, and it's unwound back to that breakdown of that gap. You had that gap at the open, and you basically unwound it. And now we're looking for either to fill or close the gap. So if you close the gap and you see euro trading above, I think it was 11.54 last close, 11.64, sorry. If you see a euro trading above 11.64, that would actually be a very bullish sign, because you've had all this massive downside and the euro has completely and utterly unwound all that downside, and it certainly seems as though that Brexit. Well, yeah, obviously there was a massive that was the initial selling pressure, but the fact that the euro's unwound that initial selling pressure is very interesting. I think I'm not necessarily saying that euro is bullish, because it isn't, but theoretically, if you see the euro closing above 11.64 now, which would be positive on the day, how is that not seen to be as near-term positive? I mean, you've sort of unwound over 200 ticks of downside in that move, so it's a significant move that would be on the euro. Interesting that there is actually a small top pattern here that would suggest that if this now falls away again or starts to fall away again, it could be that this is just a selling opportunity. So there's a lot of volatility that's around this euro at the moment, and it's interesting that on the hourly chart we've now seen that RSI unwound completely back to sort of like the 60s area, which basically hasn't got there for 4 or 5 days since the selling pressure began. So you've got massive resistance here overhead on euro dollar. I'll put the crosshair around there. So it is around 12.30, I think it is, on euro dollar. So that is massive resistance now near term. So if you saw euro dollar above that, there's no way that you could really suggest that isn't a bullish move. Bear in mind that throughout this week you're going to get a lot of news flow, a lot of volatility on Greece, until Sunday's referendum that's coming through. Then it could well be that you see a lot of volatility continuing, and maybe even continued upside, because the contagion effect on the market, I suppose, is driven by bond yields. Let's have a quick see where these bond yields are. Is it that one? Yes. Okay, the German Bund has unwound a lot of that move, actually. And we're still seeing volatility intraday. So that is very interesting. And I suppose that if I looked at the Spanish, yeah, well, it's not really done a great deal to the downside, is it? It's basically the main move has been that the German Bund has been sold off. Interesting. So the Spanish yield, so the peripheral bond yields in Eurozone are still quite high, and the German is still, well, it's unwinding. So that is interesting. So that's not a particularly... Well, is it? I mean, the Spanish yields pushing higher is not positive, because it's bonds being sold off for risk reasons. German yields coming down is interesting, though. Anyway, right. So basically, the euro you need to look out for the close tonight, I would say, and you're only sort of 10-15 ticks away from that at the moment. So that is that. Boyke, which traders caused the gap? Oh, that was obviously early in the Asian session last night. In fact, that was obviously that gap was sold off yesterday evening European time when markets opened, and it's basically been retracing that move pretty much ever since. Sort of through the Asian session, it sort of settled, didn't it? And then just has been retracing the move. So it is an interesting move on this chart. Whether it continues or not to unwind remains to be seen. I think there's going to be just volatility all through this week, and I think trading euro is going to be fun, but it's going to be hairy. Right, your cable chart. Interesting that we've not really seen any real volatility on cable. There's this sort of move around that support at 56.65. I mean, 64 was the low today, but 56.65 within a couple of pips of the couple of days low. So you'd say that's quite a big support, actually, that comes in there. Momentum indicators on the daily chart are not really that negative. You'd say that they're still fairly positive. And I still think this is just a bit of a sort of corrective drift that you've got on cable that ultimately is going to see another sort of low. Possibly, I mean, you might see it back towards this 54.50 area, but I think in terms of, I mean, we could do a very quick fib. Let me just do a very quick fib. Not going to be accurate, I might add, because of the annoyances of how my setup is. Let's do it from this one. Yeah, not even retraced 38.2% yet of the move. So you could quite easily see it 50%. 50% would be a pretty good unwind, and that's still 55.60 area. So yeah, I'd say that there is potentially still more to play in this, because you are sort of trading underneath that 23.6% fib level now, have done for the last couple of days, 3 days. So pressure on that 38.2% is fairly likely, I think, now. Wow. Sorry, wrap up in 5 minutes. I better hurry up a bit. Okay. Japanese yen. Now, this is the chart I really like, actually, dollar yen. Because the fib levels on this chart are amazing. Amazing. The rally from 118.85 up to 25.85. The fib levels on this chart have been almost to the just ridiculously well have done in terms of been consolidation and turning point. So that 38.2% has been sort of a pivot level through the last few days. 38.2%, time and time again, support, then resistance, then support on Friday, bang through that, it's become resistance again. Look at 50%. Nicely used on sort of 3 or maybe even 4 occasions, and again today intraday. Yes, you had a spike through it earlier today, but it's again almost to the pip. So that 50% fib retracement level at 22.35 area is massive, and it'll be very interesting to see if dollar yen does continue, because I've been talking about coming back to 22, that 22 figure breakout, which was that rally high in March 22, and then you broke through it, and that I've been talking about that as being your sort of unwinding point, because that also is around about that 50% level. So if you unwind half of that rally, it brings you back to 22 figure there or thereabouts, and I think that's where you're going to see the next low. 22.10 is the low today. Interesting that you're still seeing this slight drift in the momentum indicators, and I'm of the opinion that I'll be very interested to see if we do form this new low around 22 figure. I think we will. Right, let's do Aussie quickly. Sorry if I'm rushing through these. I've sort of not got a lot of time according to the powers that be. Aussie, right. I mean, it sort of has been trading sideways. Okay, macro on a macro level, it's been trading sideways pretty much throughout this year. It's been basically going sideways, and you've seen all these indicators start to sort of consolidate and come back, and seeing where they are now, they're fairly much flat, but you're now trading back below this 78 figure level. It failed, what was it, 3 or 4 times, failed at that resistance, never got a close above it, so your pressure's back on the downside. You have the RSI failing at 50, MACD lines falling over neutral, stochastic sell signal, so you're still in this negative mindset, and it still looks like, I think you're coming back to test that 75.30 level. Your initial supports are obviously 75, sort of 76 area. Interesting that we've had a rally off that 76 figure area today. Didn't quite see 75.30, but I still think that rallies are a chance to sell on this Aussie. You've got a nice band of resistance that comes in around that 76.80 mark, which is an old level. So maybe back towards 76.80 would be your chance to sell. RSI, hourly RSI up around 60. Even now, it sort of fell over around the mid-50s point. Stochastics falling over. MACD lines underneath neutral on the hourly chart. So this would suggest that all that selling into strength, I think, would still be a good idea. Hi, Richard. Do you think non-farm payrolls will still be important this week? Yeah, massively. I think massively important. I think the dollar. You've got such an amount of strong US data this week. You got ISM manufacturing on Wednesday, payrolls Thursday. You got average earnings Thursday as well. I think all these are big indicators that the Fed will be looking out for. You've got the ISM manufacturing, which is a driver of growth. You've got the earnings, which are a function of inflation ultimately, and also payrolls, which are a function of the employment market, the labour market. So three massive factors this week that could help to drive whether you get a September rate hike or not. I think personally that you're not going to get a September rate hike. I think the Fed's going to be looking out for data confirmation for more than a couple of months. Even if you get a strong month this month, I still don't necessarily think that I think the Fed's still more dovish than the market necessarily gives it credit for. And I still think a December rate hike. I mean, I could be wrong, but still, I think payrolls will be important this week. Yes, very much so. Okay, very quickly, gold. Because I know a lot of you look at gold as well. A really interesting move on gold today. Again, a complete unwind of that big gap higher. I say the big gap higher. Let me show you on this chart. On the hourly chart, you see that breakout early doors today, and then completely unwound it. This is again where you start to look at the filling the gap or closing the gap. Filling the gap is a positive aspect on a bullish break, on a bullish gap, because you've come back to fill the gap and then you start to rally again. That is a positive move, but closing the gap is a negative move. So you're looking out for that we have already filled the gap. It's just whether you close the gap now. 1175, 1174.60 is the limit, and it's around about there now. So yeah, it's sort of touch and go as to whether this is a positive move or not. I think my personal opinion is I'm still fairly range bound on gold in my opinions. I think the fact that gold continues to see RSI above 40, below 60, above 40. MACD lines basically flat, so just be careful of trading MACD lines in a sideways trading market because MACD lines aren't the best signal. Stochastics can tell you the turning points, and you've still got a slightly shallowing stochastics there. Not necessarily calling this yet as a bullish. It's not a bullish move. It would be more of a retracement within the trading band that we've been in for quite a long time on gold, several months really. Never really broken. I mean, like I've stuck the limit now back down to 1170, and that's now coinciding with all these lows back from December, January as well. So very interesting that you're sort of now looking at this range 1170 up towards 1225 really on gold. It's still a range trade I think on gold, and the fact that you had this rally today, I mean it's come up and left this low. I mean you saw this sort of deceleration of selling pressure on the last week's trade, and then a relatively positive candle on Friday, and then a strong move higher today. Yes, you have unwound it, but still I think the fact is that you're still trading this range in my opinion on gold. And because I know it's moved a lot, let's look at the DAX. Yeah, wow. It hasn't unwound a lot yet, considering Euro has unwound, but German bund yields. I mean, it has unwound to a certain extent, over almost half the candle actually. You're only 300 ticks down, so four. Yeah, not far off half the candle because it was almost five. I think 4.8% was the limit to the downside today at that 10.964. So a sharp downside move, which has actually given you a sell signal on the stochastics. RSI turning over again at that level, mid 50s, which would suggest you're probably going to drift back. I say drift, have a volatile move back towards the support around 10,800. Ultimately, I don't necessarily think this is bad yet on the DAX, but certainly the downside move that we've seen today is not great. Okay, I've been asked to wrap up by our hosts, so I well, just thank you very much for watching today. Let me just show you quickly our website. Here's the website, Handtech Markets. We're an STP broker based in London, so that's interesting. And we also, this is me providing all the market research for you. You get a daily commentary, you get weekly strategy reports, you get daily videos of euro, dollar, cable, dollar, yen, gold, and a weekly trading video as well. So lots of things to look at on the website there, and you can subscribe to my research by clicking on this button here at the top. If you want to follow me on Twitter, my handle is @HandtechRich, and I'm very happy to converse with you if you would like to. And yeah, at that point, I will show you my disclaimer again, because as I said, live market information, we need to show you the disclaimer. But other than that, I wish you good luck in your trading, and I will speak to you again next time. Thank you very much for your questions and participation today. So thanks, guys, and I'll speak to you soon. Cheers.